Let's get across the market open. Joshua Barker joining us from RiverX. Josh, good to see you. Interesting, of course, what we're seeing, certainly on Wall Street.
Yeah.
Looks as though that Trump trade, the rally we've seen post-election, has stalled somewhat.
Yeah, it seems it caught a lot of people by surprise, that clean sweep and then the reaction off to it. So a lot of catch-up trading going on, and we're seeing a pretty obvious cool off of that at the moment anyway.
All right, so how are you seeing this play out locally?
Yeah, look, we're trying to think a little bit more long term in times like this. It's a little bit crazy times in the market, and there's a lot happening, a lot to digest. So we're just almost taking a step back and looking at some fundamentals and some relative valuations, and trying to get yield obviously in the portfolio, and just tweaking our asset allocation, trying not to get sucked into too much of the craziness around Trump, and what policies he may or may not do, and not necessarily buying the US market while it's trading at almost record PE highs anyway of almost 30. So yeah, just a little bit wary at the moment of US, and it's had a great run. It's pretty easy to lock in profits and try to look elsewhere for some value anyway.
So have you actually altered your portfolio positioning since the election?
Yeah, we've had a few positions that have obviously kicked on the back of that, which is great, and then looking to reallocate into different parts of the world. So we're looking at a little bit more of a sort of emerging markets. Not a fan of China at the moment, and I do believe that sort of India's on track to take them out for their spot. They're growing at about 8%, their economy, and very young workforce, average age of about 27 over there. And what we've seen is a lot of spending go into education and infrastructure. So, all those 27-year-olds are going to be employed, and they're all, sort of upskilling, and the economy is really set to boom over the next 5 years. So, we're really confident in that market. In terms of a relative valuation, we've got even the Aussie market trading at a 20 PE. Historically, it's around 15. The Indian market's a tad higher than that, but it's been as high as 36 back in 2021. So it's sort of relative to each own market anyway. So a lot of value, I think, is in those businesses. They're all really healthy with strong cash flows, low levels of debt, and a very consumer-driven, businesses anyway.
Yeah, so there was a perception that it's obviously the Indian market's grown very strongly this year, but you're saying, well, that's justified given that overall economic growth and the potential there. So how are you playing that then?
So there's a few ways that you can get exposure to it. We're looking at mainly doing it through structured products and taking that long-term view. However, there's a few ETFs on the market that you can just get a really simple exposure to. IIND is a good example. Again, you sort of see it's had a great performance over the last year and 5 years, obviously. However, we're just seeing a minor retracement here, so I think it's actually a really good opportunity to start accumulating anyway.
All right. Anywhere else, perhaps emerging markets you'd be looking at this point, or beyond that?
Yeah, well, we're favourable towards India and Japan, and Japan obviously had those risks going on. So we're sort of putting that to the side at the moment, just focusing on India. And then outside of that, just looking for really high yield and good value opportunities, and just trying to be a little bit more forward-looking, particularly in the ASX market, with those valuations being quite high, probably mainly due to the banks, and then also, obviously the China risks going on with materials and energy names. You're having to look at a few different alternative areas in the market anyway.
So you say you're looking for high yield locally. What stocks are you looking at then?
Yeah, so looking at commercial real estate, I think, is a really good opportunity right now. Even looking further into the office space, you're getting pretty much a once in a decade opportunity to accumulate the prices that you can at the moment, with the level of certainty and safety you've got around the future. I don't think the relative valuations on office commercial property has been this cheap since the GFC. Obviously we understand why. However, if you're taking a 5-year outlook, I think you're very well suited. Something like a Centuria office REIT, 93% occupation at the moment, 93% of that is A-class tenants. You know, a lot of government, a lot of ASX listed companies in that. So, you know, you're expecting that yield to be quite consistent. And they've reaffirmed their guidance there.
Well, it's pretty much at a 5-year low too, isn't it?
Yeah, exactly. So what you're going to find is in a bit more of a short-term time frame, it's going to trade opposite to yields. We've seen yields spike as, you know, mainly the Fed is saying that they're going to be a little bit more cautious on cutting rates, and the RBA, who knows, they've really shown no signs of cutting. So again, taking that more long-term outlook, I think you're on the right side of rates coming down. And it's a little bit more of a long-term play. If this goes back to its net tangible assets, it's about 50% higher from current prices. And it's going to pay about an 8% yield in that meantime anyway. So you've got to be patient. You know, when you're trying to find value, you're not only saying, okay, this is undervalued, but then also the market's going to recognise that eventually. So you've got to be twice as patient, I guess, when you're looking for these sort of opportunities.
Elsewhere, toll road operator, Atlas Arteria.
Yeah, another one that's around the 8% mark in terms of its yield. And again, trading on those lows that you can see there. And I do think that yield really sticks in there. Again, you know, toll road operator, infrastructure play, it's going to behave the opposite to yields. So, you know, you're betting that yields are going to go down. I think they can, you know, stick in there with that dividend, because most of that dividend that they've really consistently been paying has come from free cash flows coming through to the business. They've just been hurt, which I think is a good opportunity, from some one-off tax hits that they've had on their French toll roads, and also some CEO succession payments. But that all should clear out and run through. And I guess you got to be patient. And again, it's a deep value play, this one. But you're going to get paid to be in it. You're going to get paid an 8% yield in the meantime, which is double what the market is right now in the ASX.
Just before you go, what would you be avoiding locally?
Still avoiding China. I think that their stimulus has been more of a band-aid solution. You know, even the most recent one, which the market was highly anticipating, the reaction on the back of that was obviously not good for some of our materials companies. We're really starting to see the end of that commodity cycle really start to play through. Trump hurts China, which hurts Australia. So unfortunately, you're going to experience a fair bit of pain in those areas. Don't look at the past yield on those mining stocks. You really need to look at forward yield, and obviously highly dependent on the commodity prices. So need to do a little bit more analysis when you're looking for yield, particularly in those commodity names.